£6,000 a year worth of surplus income. It's about £500 a month. That's your net income. So if you reduced your £80,000 down to £70,000, that's your £10,000 net of that, not accounting for national insurance contributions, is £6,000 after you've paid your 40% tax. So by saying, don't worry about that surplus income, I'm going to put that into my pension instead, by reducing your £80,000 down to your £70,000, instead of having £6,000 in your pocket, you're going to have £10,000 added straight into your pension. So you've made an extra £4,000 by doing that. Plus, because the employer and you have now paid or now saved on national insurance contributions, so you've saved your 2%, the employer has saved their 15%, you can say to the employer, by sending them a quick email, you can just say, look, you've saved your 15% national insurance contributions on the £10,000 you were going to pay me. Can you add that £1,500 into my pension as well? Almost all employers will do that. They might, split it, give you a chunk of it, keep a chunk for themselves just for the administration of doing it. But most of them will do that. So all of a sudden, instead of getting £5,800 back from your £10,000 once you've taken into account your income tax and your national insurance, you've now got £11,500 in your pension instead, which is, capital gains tax-free growth environment. And yours for your future. So don't ignore employers' contributions. Make sure you're aware of the tax you're paying, and where you can, use pensions to utilise tax efficiencies.
Makes sense. Very, 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 very good. Very good information there, honestly. Thank you.
It's a little bit high level.
Yeah.
But that's the sort of thing where if you've got any questions around that area, just do some research, speak to a financial planner, and they can add some serious value by just putting things in place the way they should be.
Yeah, 100%. So I think we sort of covered this, the threshold you have to pay any tax and how much you can earn before you're liable for capital gains tax. So you said it's 50,250. No,
that's income tax.
Sorry. So capital gains tax before you're liable is £3,000, right?
Yeah.
And that applies to what sort of investments?
Stocks, shares, property, anything that grows.
Been something recently in the news.
Cryptocurrency,
about personal savings allowance going down to £3,000.
Yeah.
On CGT as well.
That's on interest.
On interest.
Yeah. So I mean, this is a really good point you make, because as we're approaching a budget, speculation goes rife.
Yes.
Around what might change, and it might seem like harmless journalism, but you wouldn't believe how many of my clients who have a financial advisor ask questions and start asking whether they should be doing certain things. But the amount of individuals that take action based on speculation, which leads to really negative and detrimental outcomes, is really quite shocking.
Yeah.
So, the question there, I know you're asking about, they might be changing the personal allowance from 5,000 to 3,000. That's effectively, the personal savings allowance is where someone is someone who earns a small amount. So let's say they earn less than the personal allowance, which is 12,570.
Right.
But they have interest from cash, which is in the thousands.
Right.
Then they could potentially have an additional £5,000 worth of interest that's tax-free. So a combination of that interest and small amount of earned income, or it could all be interest. The interest is also part of the personal allowance. So if someone could have zero earned income, but earn over £17,500 worth of interest from cash, and they would pay no tax on that, because you stack up your personal allowance plus your personal savings allowance. But that savings allowance is only attributable to interest. So if that reduces to £3,000, effectively, that just means that someone who has a lot of cash and earns a lot of interest could just earn a little bit less before paying tax.
Okay, so that actual figure of £3,000, that's £3,000 interest earned on technically their savings in a bank somewhere.
So let's say they had 3% interest in a savings account. They had £100,000.
It's a decent interest rate, to be honest.
It's not a bad interest rate in a bank. That £3,000, if they had no other income, would all be tax free. If that person had income and they earned £30,000 a year and they had that £3,000 worth of interest, the savings allowance wouldn't apply because that's only for those people with low earned amount of income. So that £3,000 worth of interest, as a basic rate taxpayer earning £30,000, you'd get £1,000 worth of tax-free interest. And then higher rate taxpayers get £500 worth of interest that's tax-free. Additional rate taxpayers get no interest that's tax-free. So £2,000 of that would be taxable of the 3,000.
Those things don't really apply to anyone who's not earning a certain amount on interest.
That particular personal savings allowance doesn't affect anybody that earns not a huge amount on interest from cash. Yeah.
So I mean, to even earn £3,000 a year in interest anyway
that's a lot.
Yeah, you would have to have quite a bit in your account anyway.
Yeah, that's a lot. Bear in mind, of course, if you've got your cash in cash ISAs, that interest is not taxable anyway. So this is only interest that's in non-ISA'd savings.
So just savings then, just any savings account, current account,
savings account. Yep. Okay. Things like premium bonds don't incur tax. So you've really got to have an awful lot of cash, not doing much, not in the right accounts, for it to really become a problem. But just to come back to my point around speculation around budgets, that's one of the pieces of speculation. You see speculation around the reduction in the cash ISA allowance. You see speculation around the removal of the tax-free, 25% tax-free from pension pots. And you have thousands of individuals going to their pensions and withdrawing their 25% tax-free without a plan for what to do with the money, in anticipation for this rule coming in, which didn't come in last October when it was, some people were saying it would. I'm not going to comment on whether I think something will or won't become part of legislation. Because as a financial planner, we have to just plan based on what the legislation is, not what we think it might be. Otherwise, you'll never be able to do any planning. And in fairness to the government, when they implement changes, they don't really retrospectively punish somebody. So, if you've done something which is correct in today's legislation, if they change the law, that won't make that wrong. There'll be ways that you can go about rectifying anything that needs rectifying, but it will tend to be on future planning that you need to just make alterations. Okay. So, if they do make changes to pensions, it'll likely be future changes that you'll have plenty of time to plan for. Mm-hmm. You don't need to rush and make knee-jerk reaction decisions to speculation. But this government's indecisiveness and creation of uncertainty is really not helping.
So is that in play already, this £3,000 tax?
No, it's still